for various kinds of investments, it uses the capital. And the major ways in which it can look at the capital is either through the borrowing or using the owner's funds. Both of them, either of the mechanisms can quite comfortably be used, and probably a combination of these also can be used. And so which means when I'm looking at the overall value of the firm or value of the project, apart from the projection of the future cash flows of the project, future benefits and future cash flows the project is going to generate, we are also looking at what is the cost that is incurred for the capital that has been raised for those investments. If I have borrowed, the cost of borrowing, which is the cost of debt, which is typically the interest that is associated with the borrowing. And when I'm using my own funds, owner's own funds, then the cost is nothing but the opportunity cost, because that owner could have invested that capital elsewhere and gained some kind of interest on it, but today it's a foregone opportunity. So that's the reason both of them, whatever is the capital that is being invested, it's not a free source. So there is a cost that is involved in the capital that is coming into the investment, and that is what we are calling as the cost of capital. So both for investment decisions, investment relating to the capital budgeting kind of decisions, this is a very important ingredient. And along with that, the valuation decisions. If I want to buy the shares of some other firm, if I want to invest in some other firm, or if I want to do a takeover of some other firm, valuing that particular firm also uses this concept of cost of capital. And while discussing the IRR, we said whatever is the project, if I look at its IRR and it is greater than the required rate of return, and now I use a word, required rate of return is nothing but it's the cost of capital, the cost of funds that are typically raised for that particular investment. That is what we are calling as cost of capital. So if at all IRR is greater than that cost of capital, we say that that particular project has created the value, otherwise it has destroyed the value. Which means estimation of that cost of capital is a very essential aspect in assessing the effectiveness of a project. And let me tell you once again, this cost of capital is not an observed kind of a quantity. I can't get this value of cost of capital from anywhere. It has to be estimated. Now I will look at different sources of capital, probably the debt, the equity, and any other combinations. Combinations of debt and equity, whatever it is. For each one of them, we have to assess what is the cost associated with them through different mechanisms. And overall, we look at what is the overall cost of capital involved if the capital sources are distributed in this manner. So we make lots and lots of assumptions to determine those estimates for cost of capital. So we need to be slightly understanding that concept much more, because we also look at the riskiness of the investment in terms of deciding the cost of capital. So if the project is more and more risky, its cost of capital should be much higher, because it should give me a higher rate of return, and vice versa. And in some cases, instead of focusing on the cost of the entire firm, I may be evaluating the cost of capital for a project alone rather than the entire firm, or I may look at finding out for the firm, and depending on the riskiness associated with the project, either I can adjust it upwards or downwards. Because when I look at it as a firm, I will look at it like an average risk kind of a project. Now, if at all the actual project I am evaluating is much more riskier than that of the average risky project of the company, then I will increase the cost of capital accordingly. Otherwise, I can decrease the cost of capital. So there are multiple ways I can work out as far as the cost of capital is concerned, and we really need to consider all these various dimensions associated with the cost of capital, right? Now, one more important aspect for us to look at is on a broader scale. When I use the word cost of capital, just to define it much more in detail, whosoever are the suppliers of the capital, sometimes the borrowers, sometimes the owner himself. That is the compensation that they are typically looking at for whatever they have, the capital they have supplied. In return, they are looking at some kind of a compensation. Or from a owner's standpoint, it is the opportunity cost of these funds. Instead of keeping them elsewhere, the owner has typically supplied the capital for this particular project. So unless the project is giving me a kind of a return which is much above that cost of capital, it is not a worthy investment to go with. So if I am borrowing it, I call it as a debt capital. If I am raising it from the owners of the business, I am calling it as equity capital. So we will first look at the component cost of the capital. The debt component, what is the cost of it? The equity component, what is the cost of it? And probably there is one more which is a combination of these two, which is a preferred stock kind of a component, and I want to look at what is the cost that is associated with it. Then, depending on how much I have invested in each of them, I would try to compute the weightages. I would try to give the weightage for debt, a weightage for equity, and a weightage for preferred stock, finally resulting in the overall cost of capital. And this cost of capital is what is generally used for evaluating the various investments to take a go no go kind of a decision. And generally in the world of capital budgeting or any investment, I am more interested in looking at cost of new funds, not the existing, because for me right now, I want to raise new capital and use that capital from the investments perspective, not the older costs which at which I might have raised the loans. I'm more interested in the cost of new funds, additional cost that if I have to raise some additional fund now, how much would it typically cost me? That's the reason we treat this as a marginal cost also. Marginal is that additional fund that is getting raised, what is the cost that is built into it. So marginal cost that is associated with the debt capital, marginal cost associated with the equity capital, and marginal cost associated with the preferred stock. So when we look at from a complete firm's perspective or entire company's standpoint, if I have to compute the cost of capital, so overall, all kinds of investors put together, what is the average return they are expecting from the supplying of the capital? So, assuming debtors, lenders are some form of capital suppliers, equity investors are some form of capital suppliers. If I take all of them as one single group, on an average, what is the kind of return that each of these suppliers of capital are typically expecting? So that is why we call that as weighted average cost of capital. And in this case, it's also marginal cost of capital because we are trying to look at additional funds and the cost that is involved with the additional funds. And so depending on what is, how much of debt capital is being raised, how much of preferred stock is being raised, how much of equity capital is being raised, we try to find out their weightages, their weights, We know the costs of each one of them: cost of debt, cost of preferred stock, cost of equity. Now debt as a proportion of the whole capital, I'll try to find out. Then preferred stock as a proportion of total capital, and equity as a proportion of total capital. So these are the weights. So it is becoming as WD, weightage of debt times cost of debt, weightage of preferred stock times cost of preferred stock, weightage of equity times cost of equity. Now the only thing that comes out is, with respect to debt, we multiply it with 1 minus t. I'll discuss about why we do that kind of a multiplication. We don't do that for preferred stock and equity, and this is what will come out as weighted average cost of capital or marginal cost of capital. We apply the weights, we find out their respective costs of sources of capital, do this kind of weighted average by just doing 1 minus t factor for the debt, and finally computing the weighted average cost of capital of the company, right? So here it is, this t is the marginal tax rate, this kd is pre-tax cost of debt. So when I multiply it with 1 minus t, it becomes post-tax cost of debt, and cost of equity, cost of preferred stock. So all these things put together will go ahead in terms of determining my weighted average cost of capital. Now with that known, we can very well understand, we will try to understand some basic concepts that drive this. Why is this 1 minus t coming into picture? Right? How do I determine the weights? Right now I have just put the weights as it is. How do I determine the weights in real term? And how do I match this weighted average cost of capital to the capital budgeting world? How do I typically use it as a part of the capital budgeting process? These are the three important aspects I'll try to spend now. So now looking at why did we really deduct 1 minus t, or why did we multiply it with 1 minus t, for which we are trying to understand the impact of taxes. See, in general also, what happens is, let's say if the revenues of the company are 100, the operating expenses, let's say, are 50. So the profit from operations, or operations profit, is taken as 50. In general, in the taxation systems of the country, in majority of the countries, what happens is the interest is put up here. Let's say if the interest is 20 on the loan that you have taken, this becomes the profit before tax. And on the top of this, whatever is the tax percent, let's say it is 30%, on the top of this, the tax is applied and the net income is finally decided after that. And this net income is what is distributed as a dividend to the shareholders, or some portion of it is retained as a part of the retained earnings of the company. But yes, what we need to understand here is the interest portion, whatever it is reducing the tax that needs to be paid, because it is looking as if I'm deducting 20 here, it is becoming 30, and only tax is getting applicable on 30. However, if the interest portion was not there, the same situation, the tax would have got applied on 50, which means 15 would be the tax that would have applied. So because of this interest portion, there is a saving of tax of $6. And that 6 is nothing but the 20 into T. Tax rate is 30%. So 20 into 30%, which is 6. That is the kind of a saving of tax that is coming up. So which means the effective cost that is typically coming up associated with the debt is not the full cost. Because of taking the debt, I'm able to save something in the form of taxes also. So instead of a regular 10% being the cost of debt, I'll take it as only 7% being the cost of debt, because I'm able to save the taxes by the extent of